Okay, we're coming off a exam using a little different format than the exam two. I'd just be curious to hear, what were you guys' thoughts on that? Did that work all right? Just having um, an exam document that became available at 10 and then uploading files. Was that an okay way to proceed? We have a thumbs up. I got one thumbs up in the crowd. Sounds like okay. We got four four thumbs up, five thumbs up, and a yes and a yes. Okay, Jonathan's computer did an update during the exam. Okay, good. Yeah, okay, so good. I'm glad that worked better. We're learning how to do this as we go, and yeah, it's I had not thought through the complete implications of the way that I had formatted exam two, and so we've made adjustments, and it sounds like this is a lot better. So I'm happy about that. I'm glad that was less less stressful on you guys, and we're in the close of week 4. This is quarantine week 4. If you're keeping track of weeks since spring break, when we moved to the online version of corporate finance for the energy industry, we had 8 weeks of in-person corporate finance for the energy industry. And now we've had almost a complete 4 weeks, and after this we'll have we'll have 3 more weeks of class. We have 2 more modules. One of these is going to deal pretty extensively with the implications of debt financing or leverage. We've examined that a little bit already in specifically in last module, thinking about the levered beta. We looked at the weighted average cost of capital, which is some combination of the expected returns that equity holders require and expected returns that debt holders require. And the overall cost of capital is going to depend on some combination of those two. It turns out it's a weighted average of the individual shares, of the firm that are owned by debt holders versus equity holders. And we saw how the specifically the cost of equity capital was a function of the riskiness of the capital. So owners of a firm they're the residual claimants. They're the residual claimants. So they're the ones that are able to capture the benefits of any additional cash flows that the firm is able to generate. They also are the ones that have to eat the downside of any shortfalls in cash flow. The bondholders are the ones that get paid first. And so the beta of the stock ended up being something that reflected the risk of that asset, the risk that asset would contribute to a well-diversified portfolio. And we saw that relationship, that linear relationship between beta and the required return on the stock, where the higher the beta, the more risk that asset contributed to a diversified portfolio, the more required return that asset had to generate. That asset the firm's cash flows would have had to generate more returns for investors given a higher beta. And then we saw how, so that beta represented the intrinsic characteristics of the firm, the intrinsic characteristics of the firm's cash flows and activities, its assets, the staff, the people, those all combine, the management, those all combine to produce goods and services that people want to buy. In this case, energy products we're mainly thinking about. And then those bring in revenues, and those bring in payoffs to the owners. Now the returns to owners, we saw an example of how those can be altered under more risk or sorry, but those can be altered under a scenario where the firm borrows more. And we didn't actually look at it in the case of a firm. We looked at it so far just in the case of a gambler going to Las Vegas to play blackjack. So let me just remind you guys of this example. This is actually going to be pretty key to the stuff we do next. I want to just bring this up again and make sure that this is understandable and clear. So the scenario here, there's $1,000 that a gambler is taking to the blackjack table. There's two outcomes. There's two possible outcomes. He's taking this $1,000 along with his skills in blackjack. Maybe he has some ability to count cards, and can win more than he would lose on average. And so his payoff would be, you know, something like 1,300 in the case that he does well, and only 900 downside in the case that he does poorly. In this case, returns are 30% positive in the event that the performance is good, or that the cards turn up well. The return is negative 10% in the case that the cards turn out poorly. And so on average, this investment, you can think about this as a firm that's taking some skills, some initiative, some entrepreneurial ability, and using some capital, using some assets, in this case $1,000 of capital, taking that to a blackjack table and earning some returns on average. Now, this is the case where there's no leverage. We can then think about what would be the returns if, instead of taking $1,000 to the table.
Answers?
Yeah, the answers to the questions.
They're on Canvas, bro.
What?
Yeah, they're on Canvas. I used them.
The answers for what?
No way, bro.
Yeah, it says. I might have took them off then. Oops.
What answers are you looking for?
Yeah, I wasn't there when I checked, so I was like, what the fuck am I gonna do? So I was going through like the lectures and all.
Yeah, you're not on mute.
The past 1 hour, I went through all the lectures, but
He had them on for me. I don't know why he took them off.
I have no clue. But yeah, I like everything was on check. All the questions were on check. Sounds good.
All right, word.
Oh, they're on Chegg.
Yeah.
Oh,
You have your
shit.
drug test there today.
What?
You have your drug test today.
Yeah, I have in like an hour and a half, but I'm in class. I'm in 401 because he might do a problem set. You should join.
Vincent, could I have you mute your mic, please?
Alright, cool.
Huh?
Yeah, I'm joining.
I don't know if you do a problem set. Just
Okay, I guess I have the ability to do that. I guess yeah, okay. Excellent. So we've heard some of that. We saw this is the case in which the gambler is just using his or her own money. And then we looked at the case in which this person is still taking $1,000 to the table, and half of it's going to be his own money or her own money, and then half of it's going to be money that this person borrows. So there's going to be, in this case, you can think of this as $500 equity, $500 debt. So the assets that this person is bringing to the blackjack table are still going to be fixed, but in this case, the split between debt and equity is going to change. And we saw how that affects the payoffs. That's going to actually create higher returns when this person walks away with a good hand. So returns are 1,300 and with a good hand, 900 with a bad hand. But let's consider what the equity stake is. That is, let's consider what this person takes home after repaying his or her debt obligations. So again, this is $1,000, 500 of this person's own money, and then 500 of borrowed money. The rate of interest on this borrowed money is 5%, And so this comes to, if you think about this as 5% per year, at the end of the year, this person has to pay back 500 plus 5% interest. So the total debt service that this person has to pay back is $525. So those are fixed obligations, and that debt service has to be paid back regardless of how well the person performs at the blackjack table, or however well the cards turn up. That's a fixed obligation. That's the bondholders, the debt issuers, or the debt holders have to be repaid first before this person can come home and actually keep whatever's left over. So in each of these earning scenarios, we have $1,300 in the case of high earnings. $525 has to be paid back to whoever borrowed or whoever lent them the money, and so $775 is what what people walk away with, or what this person walks away with. In the event that cards turn up well, they walk away with $375 in the case that things turn out badly. And one of the things to notice about these numbers, it's $775 with a good hand, $375 with a bad hand. And when you compare that relative to what the individual's equity stake was, so this $500, you can think of this as the ownership stake, the equity stake. These would be, you can think of this as the stockholders of this quote firm have $500 of their own stake in whatever happens at the blackjack table. So when you take these net winnings, net of the debt service, we have 775 divided by 500, which is 1.55. That's a 55% return with good hands. The net winnings are 375 with bad cards, and so that's 0.75 ratio. That's essentially a 25% loss. And then we can compare, those outcomes in these two different scenarios with leverage and without leverage. So with leverage, 500 of this person's own money plus some borrowed money. The returns on that are going to be 55% in good times, negative 25 in bad. So the expected returns in that case are 15% positive. With leverage, they're only 10% positive on average in expected value terms. So the leverage has essentially increased the expected returns, but also at the same time increased the variance. So these returns have a higher spread. There's a higher possibility of bigger winnings that you can take home, sort of the net winnings, the winnings net of the debt service that you have to pay back, and then those spreads, the difference, the gap between the payoff in a good hand versus a bad hand becomes narrower when you're just considering this person having using all of their own money, $1,000 of their own capital. So that's a little bit of an illustration of the way that a company's leverage, in this case, this is just a one person company with one activity going to play blackjack, but the leverage increases both the expected returns as well as the variance of returns, right? So this is going to be a crucial concept for us in what we start talking about in lesson 9, and it's going to be crucial for thinking about the effect of leverage on firm value. So that's kind of just tying in a little bit of what we've already seen, tying it back into where we're going in this next section. Just to make sure, are there any questions about that example before we move forward with lesson 9 material? This next part is dealing with capital structure. We've been talking about mainly the issues we've been talking about so far have dealt with capital budgeting, figuring out which investments are worthwhile given their cash flows, given when the cash flows come, given the discount rate. We've talked about how to compute the discount rate. This this section is going to deal with not just what investments to take on as a firm. That's an important decision. That's one aspect of the responsibility of the firm's owners and management is to make good investment decisions. But another decision that they have to make is what fraction of their financing is going to come from debt, and what fraction is going to come from equity. And so that's the key. That's the key. That's the key point from this this unit that we're going to cover now. We'll see in a second. There's different circumstances under which different capital structures can affect the value of the firm. Specifically, when there's taxes on the firm's earnings, and interest payments are tax deductible. That tax deductibility is going to affect the take-home pay, essentially the take-home pay of the firm's earnings after they're able to deduct earnings from deduct interest from their taxes. That can effectively lower their tax burden, give them more take-home money, and that can have an effect on the value of the firm. We'll talk about that a little bit later. And then there's one of the key insights from this section is what's called the Modigliani and Miller proposition, which deals with the way, in theory, that capital structure, or the proportion of financing that's equity and debt, the way that choice in theory ought to affect the value of the firm. We'll see that in certain circumstances, the capital structure actually won't have any impact, and in other circumstances it will. And that gets a little bit to the tax treatment of interest that I just mentioned. But these are some of the things that we'll expound upon in this unit. You want to think about this question of firm value as being you want to think of the firm as being like a pie. There's activities that the firm undertakes. There's assets and equipment and skills and management and organizational structures that turn those raw materials, turn those pieces of equipment, turn that land into things that are valuable, and then that value gets distributed between a number of different parties according to who has an actual stake in the firm. The owners have a stake, the debt holders have a stake, the government has a stake, potentially people who could be injured by the firm's activities have a stake in the firm. If you get injured as a result of some of the firm's activities, you could sue the firm and then have some claim over the firm's cash flows. Just to simplify this, so there's a lot of people that could have a claim on the firm's cash flows. Just to simplify this for now, let's just think of the total value of the firm as consisting of the value that would get distributed to equity holders, which is this E on the right-hand side of this V equals D plus E equation. That's the equity stake. The debt stake, that's the money that will be owed to bondholders. And so the total value of the firm, if we just think about the balance sheet with assets on one side, equity and debt on the other, the total value of the firm is what can be generated by its assets, and that's composed of equity and debt. So that's just the basic balance sheet identity. The value of the firm is going to be equal to the value of the debt plus the value of the equity. And then, of course, the relative proportions of those are what we're talking about when we say capital structure. And this choice of capital structure is going to have some effect in some circumstances. It's going to have some effect on the value of the firm. And so let's get into a little bit of an example just to see how this plays out. So this is a stylized example that we're going to build upon. But there's some good key insights that we can learn from this simple stylized example. There's some key insights that we can learn about the effective leverage on firm value. So let's take this through. This is going to be a little bit similar to the blackjack example, but it's going to have a few more components built into it that are going to make it more a little bit more comprehensive, more relevant to the case of a firm. So this corporation, we're going to consider two scenarios. One of them the firm is completely equity financed. It's unlevered. It hasn't taken on any borrowing. In another case, the firm is taking on some debt. We're going to consider just two. There's an infinite number of different proportions of debt and equity. We're just going to consider one case in which the firm is going to be 100% equity, and another case in which they're going to choose some amount of debt, which is half the value of the asset. So they're going to sort of, in a sense, buy up half of the existing shares. They're going to borrow money, buy up half of the existing shares with that debt money, and just have a $4,000 equity stake as opposed to an $8,000 equity stake. So that's what this the total value of assets here is. This top column. This top column is 4,000 or 8,000 of assets. Whenever the firm is going to borrow, it's going to borrow at a rate of 10%. So that's the cost of its debt. It has to pay back 10% per year. And one of the things we're going to assume here is that when the firm takes out this debt, it's going to use that debt to actually buy back shares, and so there's going to be half the number of shares in the levered version compared to the unlevered version. So it's the debt money, the value per share in the in the unlevered case is $20 per share. It's going to take the $4,000 of that debt and actually buy up half the outstanding shares. So there were originally 400 shares, and the firm's going to buy back 200 with its $4,000 of borrowing. Right. So the equity value decreases by $4,000. So the value of equity was $8,000 in the unlevered case. It's $4,000 in the levered case because now the firm is splitting its ownership, half equity, half debt. But the underlying assets of the firm are still generating. They're still doing the same activities as they were before, and so you still have the potential to produce the same amount of overall value, at least on average. And so the equity share is, instead of $8,000 being split up between 400 shares, which would be $20 per share, in this case the equity share is $4,000 being split up between 200 existing shares. And so the market value of the share, each of these equity stakes, the total value of the equity stakes are just being divided by the total number of shares outstanding. And so the market value per share, this $20 per share, is going to just remain constant between these two scenarios because there's still the same amount of sort of overall expected cash flows being generated. It's just that there's less of an equity stake overall, and there's fewer shares overall in the levered case, and both of those effects just sort of cancel each other out, so that the share price is constant between those two scenarios. So that's the scenario that we're going to deal with. Now we're going to think about what happens under different states of the world. So these underlying assets, nothing has changed in these two scenarios in terms of what the firm is able to do. There's nothing that's changed about what the firm is able to do to transform its capital and its labor and its materials into products and services. But different states of the world, you might think of these as different just overall economic conditions, either standard economic conditions or really good economic conditions, or maybe a recession with really bad economic conditions. Those are going to affect the degree to which the firm's goods and services are marketable, and that's going to affect the amount that this firm can earn. So we're going to think about just three different scenarios. One scenario in which there's just kind of average conditions. That's this expected return scenario. There's also the possibility of an expansion and a recession, and each of those are going to have some overall earnings values associated with that. So you have some earnings associated with those different states of the world, those different economic conditions. Remember that the overall assets in this unlevered scenario. So this is an unlevered scenario where the underlying assets are $8,000. That's going to equal both assets and equity in this case because the firm is unlevered. So under these different earning scenarios, these are going to represent different percentage returns on the firm's assets. In the case that the firm has sort of normal economic conditions, or in the case that the firm is operating under normal economic conditions, it's earning $1,200 and its underlying assets were $8,000. And so that's actually a 15%, that's a 15% return on assets. And because assets are equal to equity in this case, that's also a 15% return on equity. And if we remember, there are 400 shares altogether outstanding in this unlevered scenario before the firm has taken any debt. So these are, we think about this as earnings per share. We have $1,200 of earnings per share in the case that we have sort of average economic conditions, and we have 400 shares outstanding in this this unlevered scenario. So this is going to be $3 per share. That's what happens under standard sort of average expected normal economic conditions is $3 per share. But there's variability around that because the firm's performance is always uncertain, and it's never sure that you're going to hit that expected target every time. There's some variance. So there's also a chance that we have a $5 earnings per share or a $1 earnings per share. So we can sort of, I'm going to plot this on a graph. I'm going to say that this is earnings on this x-axis. And this is going to actually, I'm going to say this is earnings before interest, just specifically before interest. Because later on, when we start having the firm take on debt, there's going to be interest payments that have to be paid after earnings come in. So this is earnings on the x-axis. And then on the y-axis, we have, I'm going to say this is earnings per share. So we have different economic conditions, which are going to result in different earnings. So I'm going to put the earnings before interest. This is the value that I'm going to put on the x-axis, these three points. So we're going to have something like 1,200, something like 2,000, and something like 400. And then there's some earnings per share that's associated with that. We have $1 earnings per share in the 400 case. We have $3 in the 1,200 case, and we have $5 per share in the economic boom, where there's a lot of $2,000 of before interest earnings coming in. So these are kind of these are the points of this graph under no debt. So those are the sort of the points along this graph for the unlevered case. Earnings before interest yields a certain amount of earnings per share. All right. And that's according to just this taking earnings under these three states of the world and subtracting interest, which in this case is 0, and then dividing that earnings minus interest, dividing that by the number of outstanding shares. That's all we're doing for that part. Now let's consider what happens when there's some new capital structure, which we've already discussed. So there's still $400 of, or there's still $8,000 of assets, but now there's $4,000 worth of equity stake. And we'll just remind ourselves here, there's only 200 shares outstanding in this case, because essentially 200 shares of the original 400 were repurchased, and now there's a $4,000 equity stake, which is split 200 ways. So each of those is still $20 per share. So now under these new economic this new leverage scenario, we still have different outcomes that are possible. We still have different states of the world, which are going to imply different amounts of earnings under those states. Nothing has changed about the total underlying assets. Those are still $8,000. So that therefore there's no change in this first row, which is the return on assets. Earnings are the same, assets are the same. So return on assets, or the earnings divided by assets, those are going to be unchanged in this leverage scenario. What's now different is that there's some debt which is going to have a cost of 10% per year. You have to, when this $4,000 is borrowed, when this $4,000 of debt is issued, it's going to entail a 10% annual interest rate, which means that $400 of interest is going to have to be paid every year. And that's regardless of how the firm performs in these different states of the world. That's independent of what goes on in the economy. There's no extra return, no extra obligation to debt holders in the event that times are good, but there's no less obligation to debt holders in the times that economic conditions are bad. So those are fixed $400 interest payments. Those are fixed regardless of what the state of the world is. And so if we subtract those from the earnings before interest, we can figure out what the after earnings interest are. And that's going to be the stuff that actually gets paid out to stockholders. It's once the bondholders are the people who get paid first, and then stockholders are the ones that get paid after the bondholders. After interest has been paid, these different pre-interest earnings are going to have $400 subtracted from them, and there's going to be a new after earnings interest, or after interest earnings, that's the stuff that's going to be dispersible to stockholders, to shareholders. So this after interest earnings is what matters for the owners of the company, who get a residual claim on the firm's cash flows. So that's what then gets divided by the equity stake to figure out what the return on equity is. So return on equity in this case, return on equity is going to be in the expected scenario, or the normal economic conditions. We have $800 of after interest earnings, which is divided up among the 20 shares. And so that's a, that's $4 per share. If we consider that after interest earnings as a percentage of the outstanding equity, that would give a value of $800 of after interest earnings divided by the $4,000 equity stake that's left in the company, right? And so that's a 20% return on equity. This $4,000 equity has produced $800 worth of cash, which is then available to be distributed to the owners or to the equity holders. So that's what we mean here by a 20% return on equity. Is the equity stakes $4,000, after interest earnings are $800, and so that $4,000 equity stake has generated 20%. Over the course of that year, it's generated a 20% return. We can consider those payoffs as well in these different economic conditions: recession and expansion. We're going to do exactly the same process of just subtracting off the before interest earnings, subtracting off the interest from the before interest earnings to get the after interest earnings. And in that case, the returns on equity under recession are 0%. The returns on equity in expansion are 40%. The respective earnings per share values are $0 per share in the recession scenario, because there's no after interest earnings, and the earnings per share are $8 in the expansion, because we have $1,600 of after interest earnings, which gets divided up in 200 different ways, given to 200 different shares, and so that's $8 per share in the good economic scenario, the boom or the economic expansion. So let's actually, we can take that back to this this graph that we had made before. We can consider under the same before interest earnings, we can consider what the earnings per share is. And I'm going to label these things for the levered scenario. I'm going to make these. So that's, we had under the recession scenario, we had $400 of pre-interest earnings, $400 of interest. So there were actually zero earnings left over after interest. And so the earnings per share after interest has been paid out, after the bondholders have been paid off, that's going to be $0. So that's that red dot in the southwest corner. Now, in the event of a normal economic conditions, we have $4 per share. We had under normal economic conditions in an unlevered scenario, we had $3 per share. This $3 corresponded to that point. Now we have $4 per share, which corresponds to the expected earnings per share under normal economic conditions. We can then remember that our earnings per share under an expansion are even higher. Those are there's $8 per share. So that's what we would put in this graph under conditions where the economy is doing well and earnings before interest are $2,000. So that's going to be something like something up here. This is $8. $8 of earnings per share. And so the payoffs under this new leverage scenario have sort of everything's become a little bit more high stakes. We have a new scenario now. Anyway, that's the line that plots out earnings per share for a given pre-interest earnings amount, What's essentially happened as a result of this this leverage is we see a kind of a counterclockwise rotation of this curve. We have earnings being a lot higher in the good times. So we have earnings in expected conditions being higher, earnings in really good economic conditions being a lot higher, but earnings in poor economic conditions actually being a lot lower. So we've manipulated the risk and return profile of this company by taking on this leverage. We have essentially, just in the same way that the person at the blackjack table went to the blackjack table with half borrowed money, half of their own money, and was able to increase their expected returns, but also increase their volatility. In the same way, the firm as a whole is able to sort of on average increase their return to equity. Their earnings per share are higher on average than in the unlevered scenario, but they face a wider spread of possible outcomes. So the spread of outcomes in, the first case, the spread was essentially, limited within this band of, a possibility of $1 per share, on the low end, and a possibility of $5 per share on the high end. In this new scenario, we have leverage come into the picture, and the spread has actually has increased. Now there's that should go as high as $8 and actually go down to $1. Or down to 0. Now the baseline is $0 per share, but the possible upside is 8. So there's been a simultaneous increase in expected returns, as well as a widening of the possibility of returns. Okay. So now the key insight here is that just as before, when we looked at the cost of capital, higher beta represented a higher risk contribution to a portfolio, and therefore the required return on equity was higher, right? So there was an expectation that you would generate above and beyond what you had done before, or above and beyond what the market could do if you have something that moves in a more volatile fashion relative to the market. The same principle is going to be at play in this case, where we have a wider spread. We have more volatility under this leverage scenario. And what that's essentially going to do is make the required return on equity higher, because this company's returns to equity, because the residual returns to shareholders, because those are larger, because the spread of possible returns are larger, we have a much wider array of possibilities under this leverage scenario. The variance is higher. The owners are going to, in order to continue investing in that company, they're going to expect a little bit higher return in order to take on that risk. And so this higher expected return, this increase from, we sort of went from $3 per share. We went from a scenario that was $3 per share in the unlevered scenario in terms of earnings per share. We went from a scenario that was $3 per share. We were able to bump that up to $4 per share on average. It's not as if just one of these contingencies was above average. We had overall the expected returns per share or earnings per share were increased as a result of this borrowing from 3 to 4. And now the question is, is that going to be overall good for bondholders, or is that going to be overall a net positive thing for the owners of the company to have the earnings per share go up from $3 to $4? So that's graphically what's going on. We went through this example. I've sort of plotted this on a graph so we can see how this affects the slope of this line. Leverage essentially increases the slope of this line. It makes these returns more more of a wide array of possibilities under particular economic scenarios. That graph came out directly from this this table of numbers. And then this is you know, just that same information, but just kind of structured in a table, the expected value numbers. And then the next question that we're going to get to is which of these capital structures is better? We have an increase in expected returns under this leverage, but more volatility. And so back to the original question of this module, what is the ideal capital structure for the firm? We're going to use this example to elaborate on that a little bit more going forward and get to answer this question of which capital structure is better.